Today's video is about recessions. What is a recession? Are we in a recession currently, or have we already emerged out of the recession? This term gets thrown around a lot lately, recession, the big R word, and I think it's important to break it down. Also, we'll break down what moves I made in the portfolio today. So, really quickly, let me just show you that we're up to 106,000 income per year. We've been adding to names in the portfolio today. Again, I will go over those towards the end of the video. For now, let's just get into what a recession is. Actually, before I do that, let me just show you, even though we're down $5,000 today, we're still up 17% for the year. Brokerage is up 17, S&P is up 8, Dow is up 2, and the NASDAQ is up 17. So we're about in line with the NASDAQ. And so even though we lost 5,000 today, we're playing with scale, and that just happens when you're playing with a larger account value and margin leverage. So, but we're still in line with the indexes. In fact, beating most of the market. The NASDAQ just has us by a hair. So let's talk about what a recession actually is, okay? A recession is defined as 2 consecutive quarters of declining GDP. You see it says up here at the top, recession is often defined as 2 consecutive quarters of economic contraction, okay? However, a recession needs to be a significant decline in economic activity that is spread across the country and that lasts more than a few months. So spread across the country. It needs to be widespread. Well, if we go look at this stat here, it shows you that GDP increased in 42 states and declined in 8 other states. So, you know, it ranged from 4.9% increase in Idaho to a negative 2.4% decrease in Alaska. Idaho, I've heard, has been on fire. Everyone's moving out of California to Idaho, and, you know, people are, exiting the cities and going to the suburbs. So places like Texas and Florida grew. It even shows here real estate and rental leasing industry increased in 43 states, including Idaho, Florida, and Texas. So this is showing actually a lot of interesting information. It gives you everything you need to know about what's happening in the economy. If you go back to their homepage, you can get all the latest drivers of the economy, and it gives you some pretty insightful information showing you how well everything is doing. Okay, we only had an economic decline again in 8 states. Okay, in 42 states we saw an increase. So, and this is titled March 31st, 2023. So this is the Bureau of Economic Analysis. I mean, U.S. Department of Commerce. This is as official as it gets. So this is not widespread. A recession means widespread. 2 consecutive quarters of declining GDP, but also widespread. So I also want to show you something on Investopedia. Investopedia was showing you when our last recession was. It says, when was our last recession here? Recent recessions. It says it was COVID. All right, but does anyone remember how fast that lasted? Yeah, it lasted 2 quarters. It was technically a recession, but that came and went so fast. Had you ignored the lows in the market and waited for this recession to be telegraphed for you to end, you would have missed the bottom in the market. You had to basically buy when we were declining in the market and calling and fearing for the recession. That was the time to actually buy. So that's what I have. I have this definition pulled up for you. A concession, okay? A thing that is granted, especially in response to demands. A thing conceded. A thing that is granted. Well, you know what we're granted during recessions? Concessions, okay? Because all they are quick buying opportunities. To look, again, Corona, the pandemic. How fast did that GDP decline? Everything was halted in the economy, and so GDP was so negative it's not funny, and it didn't matter. We all knew that they were funny numbers because they were going to resume the economy and GDP would increase again. So if you thought that was a recession and it had to last a long time or something, it only needs to be 2 quarters, and also it needs to be widespread for it to be a true recession. If you couldn't get your goods at a store because you couldn't walk in there and get it, you could order them online and still get the same goods. So business was still going as usual. That's my big problem with this market right now. Everyone's calling for a recession. Everyone's so scared of this recession. But what is the big deal? You're supposed to buy on dips, aren't you? don't you buy the S&P on dips? When are you supposed to buy the S&P? At the highs, slightly off the highs? I would rather buy at the lows, okay? But the bears right now can't make any sense of their arguments. They're saying if we have rising rates, then that's gonna cause us to go into recession because we have high inflation. We need to raise rates, so that's gonna bring us into a recession. But now they're saying, hey, we're not raising rates anymore. Inflation's falling too fast. Now we're headed into a recession because we're not growing. So none of these bears arguments make any sense. I wanted to tell you that's what a recession is. Okay, you buy all the dips, you buy everything when it's low, you sell high, forget the news, forget all the noise. Okay, and we added to OARC today. That's how we got our income up. OARC, it's now about $10,000 of a position size for us. So if we go to OARC, you'll see here that it's about $10,000. That's what increased our income so much today. I also added a little bit to Tesla, so I have $3K total in that. I would love to get more in these funds, but that's about as much risk as I can take, being that I'm in margin, 260,000 about. What does it say here? 260,000 in margin. So, I can't be taking too much risk beyond the 10,000 that I took in OARC and the 3 in Tesla. I don't mind having. I like having 1 in stocks, but this is technically a fund that covers one company. Yes, I know it's based on the company's future, but if we're doing covered calls, then it doesn't really matter the company's future. If the volatility is high, then the premiums on the covered calls will pay back the investment. So I don't mind having a little bit more in Tesla, but other than that, stock-specific names have to stay at 1,000 each while I'm dealing with margin. And even without margin, I would still argue the same thing. Put a smaller amount in the stocks, concentrate more of the money into the indexes. But through dividends, of course, that's what our last video was about, was you got to buy the secret to investing is just buy the S&P. You can't beat the S&P, but do so through dividends, so you get the qualifying income. You get the best of both worlds. Stock gains plus dividends. So yeah, that's what we did today to add to our income. We simply bought more OARC. It's really easy to jump your income up that much when they're yielding 40% dividends. But the risk of that is substantial, so I keep it in check with a certain amount of money in it at all times. I only keep 10. I don't go above that, and I'll just rebalance that. If we fall to 9, I'll just buy 1,000 more OARC and get it to 10. So I just wanted to make that video about recessions, okay? Whether we're in a recession or not, any dip is a buying opportunity, so it's all a concession. And we shouldn't be talking about recessions and throwing around the R word. We should just be licking our chops, looking for opportunities to buy, especially when they have dividends. So you're buying cheap stocks that can get capital gains, appreciation, and dividends. Again, you're getting best of both worlds. So you should just be like a kid in a candy shop right now, shopping around for all the great bargains out there and thinking long term. I mean, if you don't have to use your money tomorrow and you're investing long term for your retirement, why worry about a recession? Why not just buy the dips now? The S&P averages 7% per year. So if you buy the S&P now, you're going to be right. Even if you're wrong for a couple of years, eventually you're going to be right, and then some, because we average 7% a year. All the dips on the market are buying opportunities. Let's go look at a chart of SPY because I wanted to give you a review of what happened in the market today and for the week. So we're setting up a nice basing pattern on the S&P 500. I've documented it many times on the channel. The S&P is just going in this sideways range, and we got above the 200, which I've been calling for. We've been oscillating around the 200, but I told you back in this time period that we would break the 200. If we did break it, we would hug it. And if we did hug it, which we did, we chopped around on the 200 right here, then we would tag 380 as our next support level, which we did. We tagged 380. We've since popped back above the orange line, which is the 200, and we're trending up nicely here towards 420. We have some room to go on the RSI before we're overbought, so we could see a bigger one more day or two of gains. And we had a lot of buying volume come in after that SVB debacle. So to me, even if we chop around in this range, it looks very constructive, but if we chop around in this range, it's just healthy because we'll continue to collect our dividends. So I love a sideways market for our dividend paying names. We just sit there and collect dividends. Everyone else is out there just holding stock that don't pay them dividends and don't qualify to any banks. I can sit here and get more loans and live my life. This is a really nice consolidation pattern on a 5-year chart as well. We're just riding along that 200-day moving average. That looks beautiful. And on a max chart, we're consolidating on the purple line, which is the 50-day moving average long term. Every time we tag the 50, bounce back, tag the 50, bounce back, barely tagged it, but we bounce back. And here we're on that 50 again. So what is if the past is any indication of the future, then every time we bounce off that 100-day, that 50-day moving average, that purple line, we should see a resumption of the uptrend. Ever since 2010, the 08 crisis in 2010, that was always the trend. Okay, just the 50 was the spot to buy. Now, has the macroeconomic picture changed since we raised rates? That people might say, Todd, this has been 10 years of easy money with zero rates. Now we have high rates again. We have 5% interest rates. Are we going to see the same level of growth? Well, look from 94 to 2008. Did you see growth then? Yes, and we had higher interest rates. At one point we had interest rates in the 10s and 20% almost, in the double digits. So of course you can move higher on higher rates. And 5% is not even that high. That's like right what you want in the sweet spot of a bull market. 3 to 5% and interest rates can sustain a bull market. But we're going to pull back from 5, and we're going to be cutting in 2024 to get it down to about 3% in 2025. So 3% Fed funds rate, or at least they're even predicting under 3. That's a perfect sweet spot of, around 2% inflation, around 2% interest rates. I mean, that's perfect. That's exactly what you want to see. It's like a Goldilocks economy. So I just wanted to show you that we're looking constructive on the S&P 500. We're consolidating along that 200-day moving average. Even if we chop around for another year, we'll just collect those dividends happily. And then on a long-term chart, we're consolidating as well. This just looks all very healthy, and as if it looks like the bull trend is going to resume. I don't know when, but it looks ready when you think from a macro perspective with interest rates and inflation, and you look from a technical perspective on the chart, and you look at those the price trends. Everything is looking constructive. And then you go on to a fundamental standpoint, to a micro standpoint with the companies within the S&P 500, and all of them are doing well. They're all reporting solid earnings, even if some miss here or there. They're all making billions of dollars. They're all making income. They all have free cash flow to where they don't need banks to finance their operations, which is what I've been saying. A company like Apple does not need a bank. They have plenty of free cash flow. Even smaller companies and more volatile sectors like Energy Transfer Partners, ET, and oil and gas, they have their own free cash flows to where they don't need to pull out, raise more debt to finance their operations. So everything's just looking really positive to me in the market. You know that if you're a fan of my channel, you've seen how bullish I am on things. Why wouldn't you always be bullish? The market averages 7% per year over time. Of course you have to be bullish, and every dip you have to buy it. And you have to look at every recession as a concession. Stop throwing around the R word and having so much fear in life. Recession is not even happening, in my opinion, because this hasn't been widespread. Yes, we've had 2 consecutive quarters of GDP decline, but that's probably always happening. GDP decline. Who cares if we have 2 consecutive quarters of GDP declining, but we're still like pushing above 2% GDP or whatever it is. I heard right now, I think we still have 3% GDP from the Atlantic Fed survey. They were saying they even revised it up this week. The Fed's revising our GDP estimates down from 1.6 to 1.2. That's still, over 1%. That's still a lot of growth. We're still growing. Yes, we contracted for a couple of quarters, but overall we're above 0, so we're growing. So what's the problem? What's the problem? Why is everyone so scared? And even when the recession comes, that's like the signal to buy. That is the concession. That is the gift. That is what they're giving you. Anyway, I hope you liked the video. I hope we are clear now what a recession is. 2 declining quarters of GDP, but it's also widespread, and we have not seen widespread economic damage. Houston's going strong. Florida's going strong. I showed you some of those statistics. And again, even if we were in a recession, that's when you buy. That's the time to buy. You don't buy high, you buy low. Also, I just want to end and say that since we buy dividend names, the dividends pay back the names regardless. So they pay back the investment, they cash flow them in 5 to 10 years, whether we're right or wrong about the market going higher or lower, the dividends always pay back. In 5 years, that's paid back. Doesn't matter whether we're in a recession or a bull market, the market's going up, down, sideways, whatever. So I wish more people would invest with this approach instead of being led by their emotions and saying the R word and then telling me I'm crazy for being invested in the market like this, especially on margin. It's like, no, use margin, especially now when everything's cheap. Take a loan out and buy these assets, these quality assets when they're cheap. That's when you use margin. Why would they invent margin if it was a risky thing? And if you're going to use it, wouldn't this be the time to use it to speculate on securities that are beaten down? But don't just speculate on any security. Do it with dividends that pay it back regardless. So anyway, that's my big philosophy on investing. Take care.